So do I need a lot of money to start a high cash value life insurance policy? As we discussed in our last video, the short answer is no. But we're going to take a look at a case study here. We're going to go into some detail as well because we like doing that. We're going to look at a 25-year-old male wanting to pay $200 a month or $2,400 per year, a very small amount to begin. That's actually, when I started my first policy, I was a little under the age of 25, but it was right around that amount. I was new to the industry, kind of feeling things out, said, okay, yeah, I'll buy a policy because I was told, hey, it's a good idea. And I kept questioning it, but I did it to kind of test things out. But starting with about $200 per month, low amount. And the question is, when we start with a policy, I can A, max fund it from the get-go. And simply what that means is if I max fund the policy, I cannot add more money down the road. I am minimizing the premium, funding up very close to the MEC limit, and I have no additional room to add more money. Compared to a policy where I pay the same amount of money in, but I build more room into the equation. Meaning I've got the ability to add more dollars to an existing policy instead of starting all over with a new one, for example. And that kind of gets into the discussion, should I have one policy, a couple policies, or multiple policies? So on this point, just to provide a little bit more data here, in case you're new to this, is when we have our policy design. If you haven't seen our policy design video, I'd encourage you to watch one of those. But when I pay money into a policy, if I pay $1 in, I can choose how much goes towards premium and how much goes into my PUA rider. Dollars that go into the base premium, what you're going to find with the example we're going to look at the 25-year-old male, in respect to my cash value, 0 shows up in the first and second year. Beginning year 3, you'll see just about all of that $1,000 show up in cash value. More and more each year, I'll begin to yield dividends and interest, and I begin compounding faster. I pick up the pace. Really what happens here is the insurance company overcharges me for the death benefit on premium dollars up front. PUA dollars, if I pay in the same $1,000, what I'll see in year 1, approximately, $1,000 will show up in cash value. That's money I can access. It begins to yield the guaranteed yield right away and dividends. Now, PUA stands for paid up additional life insurance. The insurance company does consider this premium because it buys me more death benefit. Now, the question we always get is, hey, how do I put 0 of my money into the premium piece and all of it into PUAs? I can't do that. There's 2 reasons. I've got the insurance company limit. It has to do with limits, I should say. Insurance company limit, the company we're going to look at here, will allow me to 10x the base premium as far as the total payment. And then I have the MEC limit, my IRS limit. Okay, so example on the left, max funded policy. We have $2,400 per year going in until this individual is 65 years old. So the max funded policy means we are going to max out the policy from day one. I pay in $2,400. I've got $1,800 right off the bat. We were not able to achieve a 10% base premium, not funding this long. If we condensed the funding to a shorter period of time, we could have, but here we cannot. But this is optimized considering how much he's paying in his age. Excuse me. Highlighted in yellow is my crossover point breaking even between years 7 and 8. Okay. This column, cash value difference, really compares to the next example we're going to look at right now. So this policy is the exact same 25-year-old male, exact same health rating, exact same product, same company, all that good stuff. The difference is we're going to look at a $1,000 base premium and a $10,000 MEC limit. So if we go back to option 2, when we say, hey, I may want to build in more room, that's exactly what we're doing here. If I want to add more money to an existing policy instead of starting all over with a new one, because chances are high this individual's income is going to increase. Most people like whole life insurance more and more as the years pass because we see the compounding effect, the guarantees, all that good stuff. Is this policy, the max funded option, I cannot add more money to. The one where I have the ability to go up to 10K, I can add more money to. So for example, if I am 10 years into a policy, 10 years in, $23,000, I pay in $2,400. I see it grow by over $3,000. Now, $2,400 of that is what I paid in, but I'm over the initial insurance expenses in the first and second year. Remember where they overcharged me for the death benefit? My point to this is if I had more money, because I can go up to 10K per year, does it make more sense to add it to an existing policy that's over the initial insurance expenses, or start all over with a new one and go through the early years? Yeah, if my goal is cash value, of course I want to enhance an existing policy. Of course, make sure it doesn't mech or anything like that, which is easy to do. So that's why we look at an option like this. There's not one option that's better. There's not. I mean, it depends on my situation, I should say. If I said, hey, $200 per month is my number, I'm not adding more, well, hey, here's your winner. But if I said, well, yeah, I might want to add more money. My income's going to increase. I'm expecting to get a job in a couple years. That I'm going to see a huge income boost. Can I build a policy where I add more, or do I just start with this one and open up a new one after the fact? That's the kind of stuff that's good to consider. And this helps me see it, not just hear if it's a good option or not. So the key difference, there's my break-even point. Year 11 to 12, but here's really what I want to look at. Let's go to the end of the funding. And here you go. Cash value difference, about 33 grand. 250 over here versus 219. There's my $33,000 difference. So the key question to ask to help one refine or help you refine your decision-making process, if you're in a similar situation to this, is the $33,000 difference, call it in this example. That is what it costed me to build in the room or the ability to add more money into an existing policy. If we took this a step further and added more funds into it down the road, maybe when I'm 35, 45, so on and so on, well, then it made all the sense in the world to go with this one because I could enhance that existing policy. But if you said, no, I've got $200 per month of cash flow to work with right now, I want to optimize that because it fits my specific goals that I have in mind right now, I can go with this. And if my income shoots up and I want to pay in more down the road, well, then I can just open a new policy. And that's the kind of stuff to look at. And by the way, if I'm paying in $200 a month or $200,000 per year, it doesn't make a difference. If the ratios are the same, you're going to see a lot of consistencies here. So that is our 25-year-old male scenario, $200 a month. Back to the original question, do I have to have a lot of money in order to make this work? The answer is no, absolutely not. Rich cash value right off the bat. I will add is if we condense the funding period on this, or we have to force it for a shorter period of time, 10 years for example, we could get this break even between 5 and 6. But then we're not building in the ability to keep pumping in $200 per month forever. But that's the kind of stuff we like to go over as we look at different options. So as always, I hope that this was helpful. Reach out with any questions and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.